When determining your investment strategy, what is the number one important factor you need to make that decision? I've got that and more coming up. My name is Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Kevin Korhorn, the founder of Korhorn Financial Group and co-host on our weekly one-hour talk show that airs right here on this channel, has said the single biggest financial decision that you're going to make in your life is your investment allocation, what you choose to invest in. And yeah, we've had lengthy debates about that, and yet you can't really argue with him. If you're at the beginning of your career and you're, 22, 23 years old and the market's just had a turbulent time period and you say, no, I don't want any of that risk. Can you imagine going low risk versus starting aggressive because you've got a long time horizon and you'll ride through lots of ups and downs? Imagine the difference in wealth that is created or not created by that decision. Same thing maybe at 50, same thing when you retire. Your investment allocation will make an enormous difference. And so you can't really argue. And if you say, well, I don't know if that's the most important, it's definitely up there. So if it is, and if that is such a big decision, well, how do you decide? How do you decide what your investment strategy or allocation is? Well, recently saw a chart that I've seen, just tons of times throughout my career. And it illustrates, it's a different way, it's another way of illustrating what I would say, and many financial professionals would say, is the number one factor and the most important factor in determining what you should have as your investment strategy. Your time horizon. How much time you're giving that investment to work for you. Now I've talked before about, there's traders, there's investors, and there's savers. Traders are maybe day trading. They're working some sort of strategy, very comfortable buying a stock at 9:45 in the morning, selling it at 11:30, buying it back at 12:30, selling it at 3:30. And they're working a strategy for that. That's not most of us. And that's not how the average person makes money on Wall Street. In fact, many people have tried to go that route and their hopes have been dashed on the rocks there. And then there's savers, those folks that really don't like any volatility, don't want to see any ups and downs, and there's a lower risk and therefore lower return potential for those folks. And right in sort of sandwiched in between, those are long-term investors, and where maybe you own an individual stock here or there, but that's mostly play money or something like that. You have got broad, diversified investment strategies, hopefully a few of them that are implemented inside of your overall investment portfolio. Well, think about, for those of us here in the US, the stock market, the S&P 500, that likely takes up a large portion of that, of your long-term investment portfolio. Well, think about that, just for an example. If I said, hey, is investing in the S&P 500, is that a good investment? Well, it would depend on your time horizon. Say if you started, investing in the S&P 500 at the beginning of 2022. By October, did you think that's a great investment? No, your investment would be down 22, 25%. You'd say, you have no idea what you're doing. Okay, let me say it differently, different timeline. If you invested in the S&P 500 starting January 1st of 2023 until now, you'd say, oh yeah, it's a great investment, up double digits. It's fantastic investment, right? Or if you invested maybe at the 1/1 of 2009 up until right now, what would you say? Yeah, you'd say this is a phenomenal investment. So that's the same investment. Depending on your time view or your time horizon, can look like a good investment, a terrible investment, or an unbelievable investment just based on your time. So that's why your time horizon is absolutely vital. It is crucial. It is the most important factor in determining then what your investment overall allocation and strategy should be. If you need the dollars in the short term, investing in a great investment, the S&P 500, may not be a wise choice. If you need the dollars 30 years from now, investing in the S&P 500 may be a fantastic choice. Because for broadly diversified investments or or those big baskets of stocks and equities, the more time you give them, the more likely you're going to have a positive experience as an investor. Look at the far left-hand chart here. This is 1 year rolling return. So this is much better than January 1 to 12/31 each year. These are 1 year rolling returns. The dark blue bar is stocks, the light blue is bonds, and then the gray is cash. So take a look what your spectrum of returns, your range of returns would be on a 1 year time period. The average is 12%, fantastic, and lots of people quote that. However, your range, you could see a positive 60% in a year. We've seen that over a 1 year rolling time period. You can't say, well, what year was that? No, it's 1 year rolling. Okay, it's a 12-month time period, not from January to December. And negative 42 or negative 43%. That's a pretty wide range. So therefore, again, if your time horizon is short, it's very possible that you experience a return in the stock market that is well below that 12% average, right? Bonds, not nearly as volatile, but certainly not a sure thing either in the short term. Over 1 year, we've seen bonds up 35%. That's unbelievable. And we've seen bonds down 15%. And of course, cash can have some variation as well, but that's over a 1 year rolling time period. Let's move forward to a 5 year rolling time period. That average rate of return, around 11%, so stays pretty similar. You can see that average rate of return stays pretty similar with stocks, bonds, and cash, but that range of return gets tighter. It gets more clear, even though there's been plenty of ups and downs during that any rolling 5 year time period, but that range of returns gets significantly tighter and more predictable. Very interestingly enough, over 5 years, that rolling time period, that negative end of that range is about down 7%. That's pretty incredible. That really narrows things significantly. Now let's stretch that to 10 years. Those average returns are almost identical. Average just over 11, average at 6, average at 4. But again, that range of expected returns over that time period, the actual rolling 10-year time periods, it's much tighter still, with the worst performance in that rolling 10-year time period being down about 3.5%, 4%. And then let's zoom out as far as this chart will go, and that's rolling 20-year time periods. Once again, that average return is pretty similar, but that range of returns is extremely tight, especially on the stock side, where your worst return over a 20-year time period was just up 5% on average. So how much time do you have? What's your time horizon? As boring as that sounds, as much as you'd rather say, no, the biggest factor in determining my investment allocation is, most recent performance or manager tenure or what that investment strategy is aiming to do. Are they trying to outperform the stock market? Are they doing something, some sort of creative strategy? Before you get to all that, I'm not saying that stuff is not important. That's extremely important. And you can't craft a good investment strategy without looking at all of those items. But before you get there, you have to look at your time horizon. Because the point I was trying to make earlier is you can have all the right answers with manager tenure and strategy and risk adjusted return and all that sort of stuff. But if that great investment, if your time horizon and timeline isn't in line with that great investment, then it's the wrong investment for you and it's the wrong part of your strategy. So how would you apply this? This is where if you are at retirement or near retirement, this is why we strongly recommend a personal pension plan. That's what we call it, where you essentially take a fresh look at your overall investment portfolio and then align it based on, well, when are you going to need these dollars? Because when you get to retirement or at retirement, you're not going to need all of your dollars right away. Likely your retirement's going to last a couple of decades. That's still long term, and you want to have some of the dollars positioned that way. And yet at the same time, some of the dollars you're going to start accessing immediately for income purposes. Therefore, taking a look, how much income, what money will you need to be withdrawing or living on in those first 3 years? Well, that should be low risk. What about for the intermediate term, maybe years 3 to 7 or 3 to 10? Those should be more fixed income or balanced or medium risk. And then those dollars that you won't be touching for 10 years, those are dollars where you should be taking more risk. So at or near retirement, you should take a fresh look at your overall investment strategy and align it based on that time horizon. On the other end of that time frame, if you're just getting started in your career, you might be looking at the investments over the past few years and say, oh, with COVID and all this volatility and everything I hear right now is negative, maybe I shouldn't be an investor. Well, guys, if you're in your mid-20s or you're just starting your career, absolutely, there's going to be lots of ups and downs, but your time horizon is going to be well beyond that 20-year time period. And as we just saw from the data, even rolling 20-year time periods, the odds are pretty significant, pretty staggering that despite today's concerns and the short-term volatility, there should be some long-term reward for you. So therefore, what's the right strategy? Investing for the long term and kind of riding through those ups and downs. And then finally, middle of your career, I'd be careful not to follow the herd. You might say, well, yes, I've ridden through some ups and downs, and I know that's a feature of the market, not a flaw. And yet, I'm no spring chicken. I've got maybe just another decade or just a little bit more than that left to save. I really can't afford a lot more declines, and therefore I'm going to make quick adaptations and adjustments and all that sorts of stuff to try to time things. And that's a very high tendency in the middle of your career. And I would tell you, nope, continue to work with your certified financial planner. Make sure that you've got strategies that are playing both offense and defense so that you don't have to feel like you've got to grab the wheel and make adjustments and try and time the market. All of this, your sound investment strategy needs to fit well within your overall comprehensive financial plan. That's the job of your CFP. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.